the Ducascopy TV studio in Geneva. I'm joined today by Bruno Estier, our technical analyst. Bruno, welcome to the studio.
Good morning, Daniel.
So in 2015, we are also looking on the markets, and for equities, it has been quite a shaky situation. In December, the markets really rose up. Then we had a correction, and now we have another uptrend. So how do you have your look on your markets? How do you see it right now?
Well, I think we need to look at three elements. The first element is oil. The second is lower interest rates on the long end of the US bonds. And the third is an increase of VIX. So first, let's look at oil. Oil, as we can see on these long-term charts since 1985, these are quarterly candles, we noticed two things. Number one, from the level of 107 in this last year, from the top, we have just uninterrupted three-quarter down to 48. And the question is really how does it look like? Because we see this rising blue trend line has been broken, and the question is where is the bottom? It's not too clear because the momentum is extremely down. Okay, it's pushing down. So it could, people are speaking about the previous low. That's what most people think of. This is in 2008, $33. And the question is there levels before that?
And so how long can the oil price go down?
Well, you never know until it reverses. One nice thing is this level of 41 that you can find again, if you wish, on a very, very long-term chart. Here we have a chart since 1920s in constant dollar. And what we see is something that we noticed already in 2008, namely that there is a kind of a zone between 46 and 38 in constant dollar. That means oil price deflated by inflation. So they can be comparable from one period in 1920 and 2000 now. And we see that 41 is just in the middle of this pivotal zone. And also we noticed that in 2008, oil price was not able to close on a quarterly basis below 41. It just went quickly below that and come back up. So this is really the first thing. I think we have most of the decline behind us already.
So second aspect you mentioned are the low US interest rates, right?
Yes, this is a kind of a strange, if we wish. Usually in economics, when we have lower oil prices, this should be stimulative for the economy. And here, if it is stimulative for the economy, that means that interest rates should also rise because we would expect growth. Here it is just unsettlement of faster oil price down is pushing more the people to think it's going to be low inflation, and because it's going to be low inflation, it's reflecting in lower interest rate rates in the long end. And suddenly we are going below this magic kind of psychological 2% level on the 10 years. And when we look at the charts, what we notice is that we had a quick, almost intra-weeks visit of 118, and we are already down there. And most likely it's going to continue because the momentum, as we can see here, on the lower side of the panel on the stochastic and the MACD is on the way down. So probably there is not much support before the previous low, which was 116. And this 116 is the beginning in 2013 where people were speaking about tapering and again rising interest rates. So presently it looks like people are more fearing deflation somehow.
Mm-hmm. And let's have a look to the third aspect you mentioned.
And of course, if people fear deflation, they are unsure. And because they are unsure, it's reflected in some hedging activities somehow, or people wants to, who are long, wants to hedge their bet with buying puts. And very strangely, we have classical, from a technical viewpoint, a classical thing, which is this descending long-term trend line, which has been broken first in October. We noticed that. We quickly come back down below it, but we are coming a second time above it right now in December, and a third time in January. And that seems to be a little bit too much. In a sense, why is it too much? Because going back up this often is turning also the momentum of this VIX upward. And that means that possibly instead of having a nice downtrend of lower VIX with lower highs and lower lows, we are making higher lows. And that opened the risk of moving above the 20% threshold, which is a kind of a magical level. And that really is reflected now in this fear index, which is the way to measure either fear or to hedge your long-term position in the S&P. And that's what's happening right now. People are really unsure.
And what does this mean for the US equity market?
That usually is no good news for the US equity market when the VIX start to move up. In fact, if we look at this weekly chart for encompassing all of last year and a little bit of 2013, what we notice is we are more closely to the top of the channel. So it's normal that people are nervous. In addition, we are making since October kind of a rising wedge where we have a support trend line which is relatively steep, and we are just close to this support trend line. And this is what people makes a little bit nervous. And we noticed that the previous low at 1972, just in the middle of December, is probably what most people are looking at. And if we, which is the real correct level, is it 1970, is it 2000? We look at the daily charts. We can even see that if we just draw a trend line below the lows of 1972, 1992, it's right now at 2000, 2005, so we are just on there. And probably the price action of yesterday, we see a huge movement, like 200 Dow points up, so 25 points of the S&P up, and then down 15, and then closing about at where it opens. Shows a lot of uncertainty. People are just ready to do almost everything, buying if it goes up, selling if it goes down during the same session. But from the technical side, short term, it's not too good because we have here on the daily chart this kind of a bearish divergence saying that momentum is slowing down. We saw on the weekly charts also a bearish divergence, and we know that on the monthly charts, long term, already since mid of last year, there is also this divergence. So all these divergence coming on all these different time frames are saying that momentum is slowing down. So people are really nervous, I would say.
So what are key levels to watch?
I think now in mind is really not to focus too much on 2000, which is too close, but really the low of 1972. If this one is broken, that would open a kind of a double top and probably let the market go to 1820, 1850, which could not be too dramatic because it could still be part of an upward trend, but it of course will take more time. There is no sign right now that there is a 20% correction in the store.
Are these fears also reflected in China and India in the markets right now?
These are the markets that I like the most, and in fact they are not so reflected so much in this emerging market, which should be more volatile by essence. And in fact, if we look at the upper part of the panel here, we notice that the relative strength of China versus emerging market, that means versus Brazil, versus Russia. Of course, Russia had a lot of troubles, is rising. That means that China is doing much better than these two other markets, but also China is doing better than the S&P, or it stopped to underperform the S&P. So that means that there is still some hope. And on the panel of the nominal chart, what we notice is that this long consolidation, this kind of a long triangle that we see in dotted lines, is being broken, and prices are moving slowly above that triangle, and that's usually a continuation pattern, so that remains bullish. And the pattern is about the same. If we look at India, we still have an uptrend, we still have widening Bollinger Band, we still have rising relative strengths of India versus emerging market, and also from India versus the S&P. So not everything is down. So we are going to see in the coming days if, in fact, it's not a little tempest in a cup of tea just for the US market.
Mm-hmm. So, but still, you mentioned there is insecurity and volatility in the market. We will have to see how it looks like when you be there next.
Yes, with pleasure.
Thank you very much, Bruno Estier.
You're welcome.
And thank you for watching. Do make sure to keep clicking back on the Dukas Copy TV website for latest analysis and exclusive interviews. Have a great day and see you next time.